What if, while everyone's glued to Bitcoin's daily price drama, reacting to every little market tremor, the smartest money on Wall Street has been playing an entirely different game? What if they've quietly, almost invisibly, built a colossal wall of support under Bitcoin's price? This isn't some wild guess you'll see on the news. This is a fundamental shift in the Bitcoin market, a change so deep that most people are completely missing it. And right now, all the evidence is pointing to one conclusion: that $70,000 resistance level, the one that's been a ghost in the machine for what feels like forever, isn't just going to be tested. It's on the verge of being shattered. And this isn't just another prediction. It's about following the money. And for the first time ever, a tidal wave of institutional capital is showing us exactly where the price is headed. What you're about to see isn't theory, it's a peek directly into the institutional playbook. So stick with me, because we're pulling back the curtain on the multi-billion-dollar signal that proves the game has completely changed. Let's cut to the chase. For months, even years, we've all heard the same story. Bitcoin hits a new high and the world goes wild. Then it pulls back. The pundits declare it dead for the 10th time. Your friends who bought the top swear it off, and the whole cycle of fear starts over. That $70,000 mark has become a graveyard for good vibes. It's the peak of the last cycle's madness, a huge psychological wall where an army of sellers is just waiting to get their money back. Every time the price creeps up, the same question echoes online: is this the time it finally breaks through, or are we about to get crushed again? But here's the thing. That entire question is based on an old way of thinking. It's for a market that doesn't exist anymore. The real story isn't about the sellers at $70,000. It's about the new buyers. And not just any buyers. I'm talking about the biggest, most powerful financial institutions on the planet. They haven't just dipped a toe in, they've cannonballed into the deep end. The amount of net new money that has poured into spot Bitcoin ETFs since they launched is a verifiable, publicly recorded fact. This is the signal. This is the writing on the wall. And it's telling us that the fight for $70,000 isn't a fair one. It's a battle between yesterday's sellers and a massive flowing river of institutional cash, and that river is only getting stronger. So, where does this monumental pile of money actually come from? And why is it so much more than just another big, flashy number in a market that's full of them? Let's break it down, because understanding this is the key to the entire story. In early 2025, the game changed for Bitcoin forever with the launch of spot Bitcoin ETFs in the United States. For years, this was the holy grail. The thinking was simple. To get the really big money, pension funds, endowments, sovereign wealth funds, into Bitcoin, you had to make it ridiculously easy and safe for them. These giants can't just open a Coinbase account. They have complicated rules and duties that made buying Bitcoin directly a total non-starter. The ETF solved all of that in one move. Suddenly, buying Bitcoin became as simple for a multi-trillion-dollar asset manager as buying a share of Apple. It legitimized the asset. It put Bitcoin in the same brokerage accounts as the most respected stocks on Earth. And what happened next blew away even the most optimistic predictions. The floodgates didn't just open, they were blasted off their hinges. In the months that followed, we saw one of the most successful ETF launches in history. BlackRock, the world's largest asset manager, launched its IBIT ETF. Fidelity, another titan, launched FBTC. They were joined by a whole crew of other Wall Street heavyweights, and the money just poured in, day after day, week after week. The tickers tracking these money flows became a show in themselves. Some days saw over $1 billion in net new investment. To put that in perspective, the Bitcoin network itself only creates a few hundred new coins a day. The demand from these ETFs was dwarfing the new supply, sometimes by more than 10 times. This is where the big number comes from. It represents the net new capital, fresh money, being allocated to buy and hold Bitcoin in these regulated funds. This isn't just trading volume, it's real buying pressure. This money came from sophisticated investors and wealth platforms that were previously locked out, and it's still coming. This constant buying pressure creates a powerful force that soaks up any selling and builds a higher and higher price floor. Think about what a price floor really means. In the old days, a panic like a scary headline would cause a chain reaction of selling from everyday investors. With no big structural buyer on the other side, the price would just nosedive. The market was brittle. Now imagine that same scenario today. The panic selling starts. But this time, as the price dips, the institutional buyers see a discount. Their models aren't based on Twitter drama. They're based on long-term ideas about Bitcoin as a store of value. So as retail sells, they buy. They absorb the supply. They create a buffer, a massive wall of capital that helps prevent the kind of free falls we saw in the past. We can see this in the data. For years, a bullish sign was watching Bitcoin move off exchanges into private wallets for long-term holding. Today, the institutional version of that is happening on a scale that's hard to even comprehend. Billions of dollars in Bitcoin are being scooped up by these ETFs and moved into digital vaults held by custodians like Coinbase Prime. This Bitcoin isn't for trading, it's being stacked for the long haul. To really get the scale of this shift, look at the launch of the first gold ETF back in 2004. Before that, buying gold was a pain. The ETF made it frictionless. What followed was a 7-year bull run where gold's price shot up over 300%. The ETF didn't change what gold was, it just changed the demand for it by unlocking a new universe of buyers. We're seeing that exact same movie play out with Bitcoin, but in fast forward. The institutional money that has already arrived is just the first wave. The truly massive players, the pension funds and giant corporations that are notoriously slow, are still just getting started. What we've seen so far is just Wall Street's early adopters. The main wave is likely still on its way. This pile of cash isn't just a number from the past. It's a living, breathing signal of a market being reborn. It's the foundation of a new price floor, a shock absorber for volatility, and the clearest sign we have that the forces driving Bitcoin now are bigger and more relentless than ever before. This is the invisible wall of money that sellers at $70,000 are about to run into. This time is different. Those are famously the four most dangerous words in investing, and usually they are, but when it comes to Bitcoin in 2025, it's not just wishful thinking, it's a fact. This time is different, and the reason is two words: the institutions. To get how big this shift is, you have to compare the old Bitcoin market with the new one. The market that drove the 2017 and 2021 bull runs was the Wild West. It was powered almost entirely by retail investors and tech geeks. The story was a mix of revolution and get-rich-quick dreaming. Prices moved on social media hype and pure FOMO. It was exciting, sure, but it was also incredibly fragile. When the mood soured, it got ugly fast. There were no safety nets, no deep-pocketed buyers to stop the bleeding. The us versus them story was real, and them was Wall Street, who mostly laughed at Bitcoin, calling it rat poison or worse. They weren't just on the sidelines, they were enemies. Now look at the market today. The game has completely flipped. The same institutions that used to mock Bitcoin are now its biggest champions. The them has become us. BlackRock, Fidelity, Franklin Templeton, these are the pillars of the global financial system. When they launch a product, it tells the entire world that an asset has graduated. It's no longer a career-ending gamble. It's a smart portfolio choice. This changes everything, especially the investor mindset. Retail investors often think in the short term, driven by fear and greed. That's what creates those insane boom and bust cycles. Institutional thinking is the complete opposite. When a pension fund allocates to Bitcoin, they aren't trying to time the weekly chart. They're making a strategic decision for the next decade. Their logic is based on a few core ideas. Digital gold, they see Bitcoin as a modern store of value. It's easier to move, divide, and verify than gold, and its scarcity is guaranteed by math. In a world drowning in debt and money printing, this is incredibly attractive. Portfolio diversification, the holy grail for any portfolio manager, is an asset that doesn't just move in lockstep with stocks and bonds. Bitcoin has shown it can offer that, potentially boosting a portfolio's returns while lowering its overall risk. A bet on the tech. Beyond just digital gold, Smart investors see Bitcoin as the base layer for a new decentralized financial system. They're investing in the protocol itself, the most secure computer network ever created. The ETFs were the final piece of the puzzle. They solved the practical problems. Custody, how do we safely hold this stuff, was handled by insured professionals. Liquidity, how do we buy a lot without wrecking the price, was solved by the ETF's creation mechanism. Regulatory risk, will we get in trouble for owning this, was answered with a firm yes from the SEC. The data confirms this shift to long-term thinking. The smoking gun is the constant flow of Bitcoin off of exchanges and into cold storage. In past cycles, a price run-up meant coins flooded onto exchanges as people got ready to sell. Today, we're seeing the opposite. Even as the price climbs, coins are being taken off the market, showing a strong intention to hold, not sell. This is what creates a real supply shock. Every day, the pool of Bitcoin available to be easily traded shrinks. At the same time, the fire hose of demand from the ETFs keeps spraying. It's a simple, powerful dynamic. Shrinking supply is meeting a huge, new, and growing source of demand. This is why this time is truly different. The market is no longer built on the sand of retail emotion. It's being built on the concrete of institutional capital. The players are different. Their reasons for being here are different, and their staying power is on another level. They aren't here to chase a pump. They are here to systematically build a position in what they see as the most important new asset of our time. If the institutional money is the fuel loaded into the Bitcoin rocket, then the global economy is the ignition sequence, and what's happening with central banks, inflation, and world politics is creating a perfect storm, a macro tsunami of cash that's about to wash over the markets, with Bitcoin perfectly positioned to catch the wave. For the past couple of years, finance has been obsessed with one thing: the U.S. Federal Reserve raising interest rates. Higher rates act like gravity on money. They slow the economy and pull cash out of speculative things like crypto and into safe government bonds. This was a massive headwind for Bitcoin, but that era is ending. The conversation in late 2025 has completely flipped. Inflation has shown real signs of cooling. The job market is softening. The question is no longer if the Fed and other central banks will cut rates, but when and by how much. Markets are now fully expecting rate cuts to begin in late 2025. So what does that actually mean? When central banks cut rates, they're making money cheaper. This does a few powerful things. First, holding cash becomes less attractive. Second, it encourages investment and stimulates the economy. And most importantly for Bitcoin, it forces trillions of institutional dollars to go hunting for growth. This is the risk-on environment where assets like Bitcoin tend to do very well. Think of it like a dam. For 2 years, the Fed built a massive reservoir of cash on the sidelines, all earning a decent, safe yield. The coming rate cuts are the signal that the dam is about to open. All that capital will need to find a new home, and it will flood into assets with the highest potential. And this is where the ETF structure is so critical. As this new wave of money is unleashed, the ETFs are sitting there, ready to act as the perfect, regulated pipeline for all that capital. The steady flow of demand we've already seen could be supercharged by this powerful macro tailwind. The global picture adds to this. Japan and South Korea are putting clearer, more crypto-friendly rules in place. The European Union's MiCA framework has provided a rule book for the industry, which is exactly what big investors want: certainty. This global move toward regulatory clarity makes it an easier yes for conservative investment committees. Even the reasons why central banks have to ease stubborn inflation and global instability play right into Bitcoin's core strengths. Conflicts and trade tensions have made the world feel uncertain. In times of turmoil, investors look for safe havens. For centuries, that was gold. However, Bitcoin is starting to carve out its own identity as a global, non-sovereign, censorship-resistant safe haven. While its correlation to stocks and gold can fluctuate, it's starting to show signs of acting on its own terms. When people worry about the stability of their own government or currency, Bitcoin represents an escape hatch that no single entity can control, seize, or devalue. The recent move by the U.S. to establish a strategic Bitcoin reserve from already seized assets underscores this evolving view, treating Bitcoin as a strategic asset worth holding. So when you connect the dots, the picture is incredibly clear. On one side, you have a fixed supply asset with a shrinking available float because of relentless institutional buying. On the other, you have a brewing macro tsunami where central banks are about to open the liquidity taps. It's not just one bullish factor, it's a combination of powerful forces all hitting at the same time. For what feels like a lifetime in crypto, that $70,000 level has been Bitcoin's final boss. It's more than a number on a chart. It's a psychological scar from the peak of the 2021 bull run. It represents the high watermark of retail mania, and because of that, a massive zone of trapped sellers. From a technical angle, old all-time highs are almost always major resistance. The reason is human nature. Anyone who bought at the peak and held on through a nasty bear market is probably just praying to get their money back. Their main goal isn't to get rich, it's to get out without a loss. This creates a predictable wall of sell orders that the price has to fight through. Psychologically, it's even bigger. It's the point of max regret. The media obsesses over it. This creates a self-fulfilling prophecy where traders get nervous and sell, adding to the pressure. In any previous cycle, this wall would be a huge problem. It would be a 50-50 fight. But the market today isn't the market of 2021. The forces coming to challenge this wall are on a whole different level. And this is where we have to shift our thinking. The sellers at $70,000, however many there are a finite group. There's only so much Bitcoin that was bought up there. Once those coins are sold, they're gone. That sell wall has a top. Now compare that to the buying pressure. The institutional demand coming from ETFs isn't a one-time thing. It's a continuous structural flow. As long as the long-term case for Bitcoin remains, that river of money will likely keep flowing, likely. So the battle for $70,000 isn't a fair fight. It's a finite pool of sellers against a relentless river of new buyers. Every single sell order that gets absorbed by a BlackRock or Fidelity ETF is a win for the bulls. A coin is transferred from a weak, nervous hand to a strong, long-term one. The wall is being taken down brick by brick. And what happens when it finally gives way? That's when things could get explosive. The moment Bitcoin finds solid ground above its old high, we enter price discovery. Price discovery is when an asset goes where it's never been before. There's no resistance. There are no trapped sellers. The only thing setting the price is pure supply and demand. In this kind of environment, moves to the upside can be incredibly fast and powerful. Think about the psychology. The second Bitcoin is trading at, say, $80,000, every single person who has ever bought and held Bitcoin is in profit. The entire market mood shifts from anxiety to euphoria. The media narrative will flip overnight. And that's when the final ingredient gets added to the fire, retail FOMO. The everyday investors who got burned last time and have been waiting for proof that the bull run is real will see new all-time highs as the ultimate green light. They will pile in, creating a second wave of demand on top of the massive institutional base. This creates a feedback loop. Institutional buying breaks the wall. New highs trigger retail FOMO. The combined demand pushes the price even higher, which attracts more attention and more capital. This is how parabolic moves are born. That $70,000 level isn't the ceiling, it's the launch pad. It's the final gate before price discovery. And the institutional signal is the force that's about to kick that gate down. Okay, but let's be real. It would be irresponsible to paint this bullish picture without talking about the risks. No market goes up in a straight line, and even the strongest bull case has things that can go wrong. So, what could throw a wrench in the works? The biggest risk is still the macro economy. Our whole macro tsunami idea depends on central banks cutting interest rates. If inflation stays stubbornly high and they're forced to keep rates up for longer, that would be a major headwind for Bitcoin. Another risk is geopolitical. While we've argued that chaos can be good for Bitcoin's safe haven story, a really severe global event could trigger a mass risk-off panic where investors just sell everything to get to the safety of cash. In that scenario, Bitcoin would likely drop too, at least in the short term. And finally, there's regulation. While things have been going in a great direction, a sudden hostile move from a major government could still shake confidence. This seems less likely now that Wall Street giants are so invested, but it's never zero. It's also important to remember that these big ETF flows can reverse. We've seen weeks and even a month of significant outflows, showing that institutional money can be fickle. But acknowledging these risks isn't a reason to be bearish, it's a reason to be smart. And this is where we can learn from the institutional playbook. Their strategy isn't about perfectly timing the bottom or going all in at one price. It's about building a position over time with conviction. Institutions don't flinch at a 20% correction. They see dips as opportunities to buy more at a better price, lowering their average cost. Their strategy is patient and disciplined. They aren't staring at the 15-minute chart. They're looking 5 or 10 years down the road. For the everyday investor, the lesson is clear. Instead of trying to day trade the chaos, it's wiser to adopt a similar mindset, understand the powerful long-term forces at Bitcoin's back, the structural institutional demand, the shrinking supply, and the changing macro landscape. Use that conviction to build a position you're comfortable with and see the scary red days as potential buying opportunities, not reasons to panic. The game is no longer about outsmarting the market day to day. It's about aligning yourself with the biggest financial forces in the world. They've shown their hand. They're accumulating Bitcoin for the long run. The smart play is to invest alongside them, not bet against them. If you silence all the noise of the daily market, the flashing charts, the screaming headlines, the picture becomes incredibly clear. Wall Street has arrived. They've funneled tens of billions of dollars into Bitcoin, creating a foundation of demand this market has never had before. This isn't hot money, it's patient capital from the world's biggest players, and they're just getting warmed up. They've built a price floor beneath our feet that has changed the entire nature of the asset. At the exact same time, central banks are getting ready to open the liquidity floodgates, forcing a wave of capital to find a new home. Bitcoin, now fully legitimized and easy to buy, stands to be a primary beneficiary. That $70,000 wall of doubt is the last major obstacle. It's a wall built by the sellers of yesterday, and it's about to face a tidal wave of institutional capital. Its downfall seems less a matter of if and more a matter of when. And on the other side is price discovery, a world with no limits and no resistance. This is more than just another market cycle. This is a fundamental repricing of an asset. It's Bitcoin's graduation moment. The game has changed, the players have changed, and the rules have been rewritten. The question is no longer if Bitcoin will be a cornerstone of the modern portfolio, but how you'll position yourself as it happens. If you want to stay ahead of these moves and understand the data that really matters, make sure you subscribe to the channel. We're just scratching the surface, and you don't want to miss what's next. Thanks for watching.